Good afternoon. This is Rob Hoxton, and you're attending the HFI Wealth Management Halftime Report with Chris Dorsey. It's great to have you on the call. As usual, we haven't figured out the technology well enough to be able to accept questions during the webinar, but we sure do encourage you to send an email or to give us a call, call your advisor, and we'll answer your specific questions. Today, Chris Dorsey is presenting. Chris is, in addition to having his master's degree in finance and investments from Daniels College at the University of Denver, Chris is also a chartered financial analyst. That's a designation, a professional achievement that is usually reserved for the highest level of investment professionals. So we're really proud to have Chris with us today. He is, again, HFI's portfolio strategist and analyst. So he's going to talk to us here in a couple minutes. As we go through the presentation, we're going to talk about what's happened in the first half of the year. We're also going to touch a little bit about the volatility that the market's been experiencing over the last month or so, and what to expect, and kind of our point of view on that. So without further ado, I'm going to go ahead and hand off to Chris, and he'll take it from here. I'll be back with everyone here toward the end of the webinar.
Thanks, Rob, and welcome everyone. Thank you for joining us today. For those of you that have been with us before, welcome back. Those that are new, we hope that the next 30 minutes or so will be beneficial for you. The format of the webinar is going to be the same as previous webinars. As Rob said, we'll talk about a few of the main events from the first half of the year. We'll look at where we are now as we move into August and the rest of the year, and then we will touch on a few of the things at the end of the presentation that we're watching through the second half of the year. So 2015 has certainly been a much different year in terms of market performance compared to 2014. What you're seeing in this chart here is a comparison through the first 7 months of the year for some of your major U.S. indices and global asset classes. So the 2014 performance and the 2015 performance are both through the end of July. If you look at the S&P 500, we're up about half of where we were at this point last year, just slightly over 2% through the end of July. Actually right around flat line for the year after the last couple of days in the market. The Dow Jones is down 0.75% through the first half of 2015. Real estate, which at this point last year was one of the best performing asset classes, is actually slightly negative for the year. Non-U.S. stocks, pretty consistent with where they were through the end of July of 2014, up a little over 2%. One of the biggest improvements from 2014 has been international developed equities. If you look at the MSCI EAFE index, last year was just slightly positive at this point through the end of July. And currently, the MSCI EAFE is one of the best performing areas of the global market, up 6% for the year. Emerging markets, completely different story. One of the best performers at this point last year, up 6.3%. Currently, emerging markets are down almost 6% through the end of July. A lot of that weakness has come from the significant decline in commodity prices and also the situation in China, the slowdown there, etc. So we'll touch on that a little later in the presentation. And then commodities, this should come as no surprise to anyone, but commodities, the worst performing asset class for the year, down 12%. And we'll touch on a few of the reasons why that's been the case later in the presentation. Certainly been a volatile year, especially for some of your major U.S. indices. The S&P 500, which represents large cap stocks, which was the top performing area of the market last year, the U.S. market last year, was up 13%. Small caps in comparison were only up about 2% for the year. So there was a very wide dispersion in terms of your size performance last year. This year, it's a much tighter range. The S&P 500 just up slightly. Mid caps are slightly ahead, I think around 3% as of the end of July. And then the Dow Jones, similar chart as the S&P, very volatile year for the Dow, blue chip names. The Dow's actually negative for the year. One of the reasons that we've seen a lot of your large cap companies come under pressure this year has been the fact that the dollar's been strengthening since last year, and a lot of your larger cap companies tend to be multinational, have operations overseas. So the significant amount of revenue generated overseas is negatively impacted by the stronger dollar. We've seen that in the last couple of quarters in earnings reports from these companies. that's been one of the reasons why we've seen relative underperformance and weakness in the large cap and blue chip space. The NASDAQ index is a completely different story. It's a much smoother ride, as you can tell from this chart, compared to the last two. The NASDAQ has more of a focus on smaller cap companies. It has a higher allocation to biotech stocks, which have been one of the best performers for the year, and then also technology companies, which have also been a solid performer for the year. And overall, the NASDAQ is up 8.3% through the end of July. If we take a look at U.S. GDP, we see that the U.S. economy contracted in the first quarter of last year. A lot of that was due to a very harsh winter. Economic data or economic GDP recovered in the second quarter of last year, up 4.6%, and it's been positive over the last several quarters, but you see a pretty steady decline through the end of last year and the beginning of this year. There's been a number of reasons why that's been the case. One, as I said, the dollar's been strengthening over the last year, which has reduced exports. It's made them more expensive for other countries. So exports have declined, and that's one of the factors that goes into the GDP calculation. Another headwind for the GDP number has been the decline in oil prices, which has resulted in a significant decline in the revenues and earnings for oil companies. So the investment from the energy sector has significantly declined over the last several quarters, so we've seen that cut into the GDP number. We're still positive, and we actually had a rebound in the second quarter of this year, and the U.S. economy expanded at a 2.3% pace. Just to touch on, again, we mentioned these in the last slide, but a few of the reasons why there's been improving but slowing growth in the U.S. One is oil prices, which have reduced investment from energy companies. The stronger dollar has resulted in a decline in exports. Consumer spending is actually an interesting piece in the market. We've seen the labor market improve consistently over the last several months. We had over 200,000 jobs created in July. That's been pretty consistent throughout the year. And a lot of your experts have been saying that the strengthening of the labor market would turn into an increase in consumer spending. And we're really not seeing that, especially reflected in retail sales. We have the next retail sales report coming out tomorrow, so we'll see where that is, if that reflects an increase in consumer spending. But as of right now, we really haven't seen a significant increase in that area of the GDP calculation. Wage growth has also been slow, so that's been a headwind for the consumers. So all of these are factoring into the Fed's decision on whether or not it will increase rates in September, or if it'll wait potentially to December or maybe even next year. If we look at economic growth in Europe, again, if you remember from one of the first slides, the European markets have been one of the best areas to invest in this year. Well, part of that is due to the significant improvement in many of your European economies. You have the ECB, which is underway with its own form of quantitative easing, similar to what we did here in the U.S., coming out of the recession. And a lot of these companies that you're seeing here on this chart were actually in contractionary situations over the last several years and have now turned to growth. So while these growth numbers don't look that significant, it's a strong improvement from where many of these countries were last several quarters. So certainly that's helped to drive economic growth in Europe, which has in turn helped to drive their stock markets. Again, just to touch on a few points of why the quantitative easing program from the ECB has been a tailwind. One, it has reduced the value of the euro relative to the dollar, which has increased exports and increased their GDP numbers. And also the decline in oil prices has resulted in a decline in gasoline prices, similar to in the U.S., which has put more money in the pocket of the consumer. This is one of my favorite charts in the presentation. This is a very interesting situation in many of your European countries. The fact that interest rates are actually negative at this point in time. If you look at Switzerland, negative 0.8%. Sweden and Denmark both down about 0.2% for their interest rates. And what this essentially means is that borrowers are being paid to take out loans, which seems like a pretty good deal. And it's certainly unique times that we're witnessing in many of your developed markets at this point in time. Here's a story from the New York Times from February of this year. And it's just a story about a woman in Denmark who took out a small business loan and actually had, as we saw in the last slide, a negative interest rate. So she was being paid to actually take out the loan. So this defies, everything that we would think would be the situation. And there's certainly, in terms of monetary policy and interest rates, it's very unique times that we're going through. And we're seeing that in the European economies right now. The net effect on European stock markets from the quantitative easing has been positive. We've seen many of the markets outperform their U.S. counterparts. If you look at the FTSE, which is known as the FTSE, it's a UK benchmark. It's up about 2.3, so pretty consistent with the S&P 500. If you look at Germany's main index, it's up almost 16% through the end of July, and France's main index is up almost 20% through the end of July. So that's much greater than the numbers that we're seeing here in the U.S. And again, a lot of that is due to the fact that the ECB is maintaining very accommodative policy at this point in time, whereas the U.S., we're about to tighten our monetary policy, increase the Fed funds rate, etc. So that's one of the reasons why we're seeing the European markets outperform this year. The ECB wasn't the only central bank to implement QE recently. The Bank of Japan, as of late last year, initiated its newest round of quantitative easing in an effort to push inflation to 2%. The Bank of Japan is actually credited with inventing quantitative easing. It began it at the turn of the century and essentially has used it ever since in an effort to encourage growth in the Japanese economy. Of course, deflationary pressures, aging population, and a declining workforce have all been impediments to significant growth in Japan, but nonetheless, we have seen some improvement in the Japanese economy, especially recently. The inflation target, pushing that to 2%, really didn't work out. Oil prices were the main headwind. It's keeping inflation close to zero in Japan, but nevertheless, the low oil prices and a weaker yen relative to other currencies should drive improvements in the Japanese economy going forward as they're able to increase their exports. As we did with Europe, let's see what effect the QE is having on markets in the Asian regions. The Nikkei, which is Japan's main index, is up 18% for the year. If you look at Hong Kong's index, the Hang Seng, only up 4% for the year, and China's composite main index is only up 9.3% for the year. And if you take a closer look at this chart, the light green line is the Chinese composite index, and you can see that it was up significantly through the beginning of June of this year. But after that, June 12th was the high in that market, and after that, essentially the bottom fell out of the market. I'm sure that comes as no surprise to anyone who's been following the news. Chinese stock markets dropped some 30% in a matter of weeks in the end of June, so that certainly raised a lot of concerns in the market. So let's take a closer look at that situation. China's stock market built on the gains that it had in 2014. It was up significantly last year. It was up 50% at one point at the beginning of June this year. So many feared that the values of those companies, many of the companies in the Chinese stock market, was getting extremely elevated. The valuations of these companies was becoming disconnected from fundamentals. And essentially the bubble, quote unquote, burst in the second half of June, which resulted in an almost 30% decline in the index over the last couple of weeks. Just a few examples. A pet food company in their market was trading at over 200 times earnings. A sauna maker was trading at almost 300 times earnings. And a fan manufacturer was trading at over 700 times earnings. So again, these valuations are extremely disconnected from the fundamentals, and it's one of the reasons why we saw a lot of those prices get reined in quite a short period of time. This is a closer look at China's composite index that we saw on a previous slide. Again, as I said, through June 12th of this year, this index was up almost 60%. Significant. It was one of the best performing areas in the global markets. And in just a matter of weeks, it fell almost 30%. The Chinese government, thinking that it can control what the market does, stepped in with a number of measures to try to support the sell-off and support the prices in the market. One of the things that they did was suspend IPOs. They also lowered interest rates and bank reserve requirements. They restricted major stakeholders from selling their shares. And finally, they also injected a massive amount of liquidity in the market. And as you saw in the previous chart, this really didn't have the impact that the government was hoping. Markets slid, again, 30% in a matter of weeks. And actually, surprisingly, as you saw, the index is still up over 9% for the year, even with the massive sell-off that occurred in late June, early July. Certainly still concerns surrounding China and the impact that that will have on global growth. So let's look back at some of the main themes from the previous 7 months. Let's take a look at where we are now. Economic data, again, is improving here in the U.S., but some of it has been mixed, missing the mark. Economic data overseas is improving in some areas, declining in others. Greece is still in the headlines after all of these years. There's been no shortage of speculation on when the Fed will increase the Fed funds rate. Some expect September after the strong jobs report last Friday. But some think that given the news out of China recently this week, that rate hike may come later in the year or even next year. And then oil prices we expect to certainly remain volatile given the number of issues affecting that area of the market. If we take a high-level look at the global economy, you can see that it's a somewhat similar picture for some countries and vastly different for others. The U.S. GDP is slow and steady here. Inflation's in check, and unemployment is actually near where the Fed wants it to be, around 5.5%. Similar case in Japan. If you look at Russia, however, the economy is expected to contract there in 2015. One of the major reasons for that is the decline in oil prices. Russia derives a significant amount of its country's revenue from exporting oil. So this is not only the case with Russia that the decline in oil prices is having a significantly negative impact on its economy, but that's the case for many of your emerging market countries that are net exporters of oil. So this is probably something that we're going to see going forward, some weakness in emerging markets as commodity prices stay under pressure, and also depending on how the situation in China plays out, that will also have an effect on that area of the market, the emerging market space. So it seems like we just can't get Greece out of the headlines. It seems like almost every year there's talk of a Grexit or an exit of Greece from the Eurozone. At the end of the second quarter of this year, Greece was unable to reach an agreement with European leaders on a reform package in order for them to secure additional bailout funds. So consequently, they defaulted on $1.5 billion euro payment to the IMF. And as the negotiations kind of played out and dragged along, Greek banks were actually closed for more than a week. The stock markets were closed for more than a week. The voters were presented the deal by the EU, and they rejected it. And of course, the current political party in Greece was elected based on their anti-austerity stance and position. So it's been a tough sell for the political leaders, knowing that they need to secure a deal or they have to leave the Eurozone, which would be negative for them. But they know it's going to be a tough sell to the citizens. Our position on this has been consistent. We felt that there's a lot of political posturing going on, and we did not feel that it was likely that Greece would exit the Eurozone. And we've actually recently found out in the last week that Greece and European leaders are actually nearing a deal. They're pretty close to finalizing it. So we should see that situation, at least for the time being, kicking the can down the road. But I would expect to see this come back into the headlines over the next couple of years, because the Greek economy is certainly in a bad situation and they need to implement austerity measures. But whatever plays out there, the residual effect on other markets would be relatively minimal, just given the size of Greece's economy. And one of the biggest news events over the last year has been if and when the Fed will decide to increase the Fed funds rate for the first time in 9 years. Again, after Friday's jobs report, which was well over 200,000 jobs created in July, there was speculation that the Fed would definitely increase rates in September. But again, depending on what retail sales look like tomorrow in the report if the consumer isn't coming back as a result of declining oil prices, stronger dollar, wage growth is still stagnant, and more importantly, I think the situation playing out overseas, particularly with China, the devaluation of their currency and the slowing of their economy, I think the Fed is more likely than not to wait on increasing rates. We're probably looking at maybe December or even next year now, given that. And just given the tailwinds that the U.S. dollar has and inflation currently being as low as it is, they really have no reason to jump the gun on increasing the Fed funds rate. So I think it's becoming increasingly unlikely that the Fed will use the September meeting as the platform to increase rates. So we'll see what happens with that. And yeah, just a lot of speculation surrounding this whole event. It's in the news almost every day, and really we'll see what the impact is. But I would expect there will be volatility leading up to the rate hike whenever it occurs, and following the rate hike. But if you take a step back, it actually is a signal that the Fed has confidence in the U.S. economy, that we are getting stronger, that the consumer is coming back, that manufacturing and industrial production is increasing, that the housing market is getting better. So I think the actual takeaway from that event will be a positive, but we do expect volatility surrounding that event. I want to touch on oil for a little bit. That's certainly been in the headlines over the last year. This is a chart of Brent Crude at the top of this page here. As you can see, the price of oil pretty much traded in a tight range for several years. And then last summer, essentially the bottom fell off, and oil declined over 50% in a matter of months. A few of the reasons for that swift and significant decline was record supply of oil, not only in OPEC member countries, but also here in the U.S. A lot of the increase in production here in the U.S. is due to new technologies, whether horizontal drilling, fracking, all of those new technologies have substantially increased the production in the U.S., which has resulted in an oversupplied market. More recently, the deal with Iran will almost immediately release millions of barrels of oil that they have stockpiled into an already oversupplied market. And if and when the sanctions are lifted on Iran, that will give them the ability to significantly increase their production back to where they were before the sanctions, and that will also further oversupply an already oversupplied market in terms of oil. And then the slowdown in China and the devaluation of their currency recently is increasing concerns of slowing global demand for oil. So there's currently, and has been for about the last year, a pretty substantial disconnect in terms of supply and demand in the oil market. It's not all bad with low oil and commodity prices. One of the benefits, as we've talked about in previous webinars, is that the decline in oil prices results in a decline in gasoline prices, which of course puts more money in the pocket of the consumer. At the pump, they're saving money. And this has been somewhat of a tailwind for the consumer, but again, we're not seeing it reflected strongly in the retail sales number. And with all of the other headwinds to the GDP number, the consumer spending aspect of GDP really hasn't made that big of an impact. But again, at the individual consumer level, it's certainly nice to be able to save some money at the pump. And we expect, given the headwinds for commodities in the near term, that this will continue to be a tailwind for the U.S. consumer. We feel that the current level of oil prices are unsustainable. We think that eventually in the intermediate to long term, the prices will recover from current levels, maybe not to the level that we saw last summer, but certainly higher than where we are now. The current prices of oil are well below the break-even levels for many of your OPEC member countries and non-OPEC member countries. So the main goal of OPEC right now is to maintain production in an effort to push out the U.S. producers that are now producing at record levels. We really haven't seen that take effect yet, but again, this is more of an intermediate and longer-term impact that it will have. We feel that over time, OPEC will either succumb to the pressures in the region and cut production. We feel that if prices remain low for longer, that high-cost, unprofitable U.S. producers will eventually be shut down, which will reduce supply. And also there's the chance that China recovers from their current situation. They continue to import oil at record levels, and then demand increases, which cuts into the oversupply in the market. And eventually we expect that supply and demand imbalance to come back to more normal levels. And again, longer term, we think that the price of oil certainly will move higher than where it is now. And if you're a client of ours, you'll recognize that in our portfolios, we actually feel that this is an opportunity, and we've maintained our exposure in the energy sector. We think that it's worth it to withstand some of the near-term volatility, because we feel that it offers a great long-term opportunity in terms of where the prices are for many of those stocks compared to their long-term fair value. So taking another look at China, so obviously the 20th century was a century of the U.S., the UK owned the 19th century, and many expect that Asia is now taking over in terms of influence in the world on the national scale, that China is becoming much more influential than the U.S., and that they will overtake the U.S. In the 21st century. It will be the century of Asia, and in particular China. As you may know, during the first half of 2015, China launched what was known as the Asia Infrastructure Investment Bank, the AIIB. What the AIIB is an international financial institution that's focused on supporting infrastructure investment in the Asia-Pacific region. So it's viewed as a rival for the IMF and the World Bank, which are dominated in terms of influence by countries, developed countries like the U.S. And so this is essentially viewed as China's way of saying, okay, we haven't been supported enough on the international front in terms of our growth. We haven't been supported. We need to be recognized. Our influence is increasing. We're becoming one of the major players. And that was one of the reasons why they developed the AIIB. They have 57 countries that joined the bank, which is more than a fourth of the world's nations. And currently it has 16 of the world's 20 largest economies as members. And the four that are the exceptions are the U.S., Japan, Mexico, and Canada. And just as the U.S. has significant influence and control in the IMF and the World Bank, China will have a similar influence in the AIIB, given that they put in a control or a restriction that non-Asian countries can't hold more than 25% in the bank. So China will maintain significant influence in this new entity, and we'll see how that plays out on the global scale. So that's a look at where we are now as we enter the second half of the year. So now let's talk about a few of the things that we're focusing on, a few of the major events that are coming up in the next couple of months. Obviously, the Fed rate hike and the reaction, not only in the U.S. but globally, to that event. Economic growth, we've seen improvement in some countries. We've seen declines in other countries, namely emerging markets and those that have a more of a reliance on commodities. Is the bull market over? Is the bull market just halfway done? Do we still have a lot of room to run in the U.S.? And obviously there's no shortage of pundits who support bear market theses as well. So this is Larry Summers, former U.S. Treasury Secretary, and he essentially believes that we're in a state of what's known as secular stagnation. And his justification for this is the fact that real interest rates have been on the decline recently. Secular stagnation is essentially a situation where you have high per capita income, which results in a high savings rate. So people are consistently making more money, which results in an increase in savings from those individuals. And eventually, the savings rate outpaces the rate of investment in things like infrastructure and education, which are crucial to long-term economic growth. So as investment in infrastructure, education, etc. decline, you eventually have a decline in economic growth. As the economy declines, that reduces per capita income, which reduces savings from individuals. And essentially what that leads to is a situation where you have reduced investment, reduced savings, and the economy essentially comes to a standstill. So that is what he feels is the situation. I tend to side with Ben Bernanke. I don't think that that is the situation at all. Ben Bernanke believes that it's more cyclical and special factors that are impacting real interest rates and economic growth at this point, and I would tend to side with Ben Bernanke here. As we discussed earlier in the presentation, there's a couple main reasons why economic growth, while positive, has been suppressed. One of the big reasons has been the decline in oil prices, which has resulted in a decline in investment in the energy sector, and that's been a big headwind for economic growth. And also the strong dollar has significantly reduced exports. We've seen the dollar strengthening substantially versus many international currencies over the last year, and that has significantly reduced exports, which has cut into that GDP reading as well. So I think there's a lot of temporary factors that are weighing on economic growth here in the U.S., and these factors are not permanent. They are temporary, as I just said, and we feel that as those conditions improve, most notably in the energy sector, we feel that economic growth will start to increase at a faster rate here in the U.S. The IMF is certainly bullish on developed economies, which is consistent with our views. We feel that, particularly here in the U.S., economic conditions are improving, the labor market's improving, the housing market's improving, and then in Europe, we've seen a lot of those countries return to positive economic growth. We saw that on one of the earlier charts. You have monetary stimulus in many of your developed economies, and we feel that this will continue to drive positive performance going forward in developed economies. The situation in China is, I think, concerning in the near term, and it's more specific to emerging markets than it is to U.S. markets. I really don't think that any significant slowdown in China is going to have a substantial impact on U.S. markets. It really would have a minimal effect on U.S. GDP. So I think the situation in China is more headline news. It creates fear, causes volatility in the markets, but I think the actual impact long term on the U.S. and other developed economies will be minimal. And here's Ken Fisher, and he makes an interesting point. He essentially is saying that you have no shortage of potential landmines in the headlines in the media and the news and CNBC, and typically you don't get a top in the market or the end of a bull market when you have all of this fear and uncertainty in the market. The end of bull markets is typically surrounded by extreme euphoria, irrational exuberance, and that is a situation that we certainly don't have right now. So that is an interesting take on and in support of continuing a bull market here in the U.S. And when I talked about this in the most recent HFI commentary that we sent out last week, but we expect volatility certainly to surround the Fed rate hike leading up to it and following it. We definitely think that there will be volatility. There probably will be pressure on equities in the U.S. and globally, but I think once people digest what it actually means, they'll see that it means that the U.S. economy is getting stronger. There have been improvements here, and the Fed has enough faith in the improvements that they're seeing to support a rate hike, which is consistent with the strengthening economy. So I think if you look at this chart, which is based on historical figures going back to the early 90s, you can see that there is some negative pressure immediately following the rate hike, but more often than not, 6 months, 12 months out in the intermediate and long term, it is seen as a positive, and it does result in positive performance, and this is consistent with where we are on the U.S. And just to end, again, there's no shortage of scary headlines in the media. If you're following that, China's a concern, and commodity prices are a concern. And that's why it's more important than ever to focus on a process that eliminates emotion from the decision-making process, which we know only hurts investment returns. It's been proven, and that's what we're going to do. We feel that there's always opportunities, there's always risks in the market, but there's always opportunities, and we rely on our process to alert us to the risks and move us towards the opportunities. And we're going to continue to do that and monitor the events as we enter the end of 2015 and make adjustments as necessary. But just remember that there's always opportunities, regardless of how scary the headlines look. So with that, I'm going to pass it back to Rob to wrap things up.
Chris, that was terrific. Thank you so much. I hope that our listeners and viewers found the information to be helpful. You know, we are on top of what's going on in the markets and the economies, but also recognize that sometimes when you have lots of things in the press, it can be stressful for clients. We try to be very proactive in reaching out, but we encourage you, if you're concerned, to please give us a call, and we're here to help. Nothing that we see at this point is of enough concern to make any significant changes in portfolio strategy, and we think that there's plenty of opportunity going forward, and are excited about what is around the corner for us. So again, we will encourage you, if you have questions, to call us after the webinar, shoot us an email, we'll respond. This webinar is also being recorded and will be made available on the website in the next day or so. So if you want to listen to another piece of it or forward it on to a colleague or friend or family member, we certainly encourage you to do that. So without further ado, I think what we'll do is wrap this up, let everybody get a quick bite of lunch, and get back to work.